All right, quick sight and sound check before we get underway. Can everybody hear me okay? And can everyone see the screen in a lovely, dignified, solidified, fortified, yet revolutionized, and then some fashion? I hope is excellent. I appreciate that. Thank you, sir. Thank you, ma'am. All right. Thank you, sir. All right. So let's get underway here. Now, this presentation to me, when I first went through it, I was like, this is just a good reminder presentation. Now, if you're kind of brand new or newer to options, especially as an investor, this might be something that you really haven't thought about at all. But I think most of us that have traded options a little bit kind of realize this, but often we forget to think about it. I cannot tell you how many stories I've heard from my students about, yeah, I bought these shares at 80 bucks or trading at 30 bucks, but I'm just here for the long run. I'm going to ride it out here. Right. But it's a better way to do that. It's a better way to do that. So that's what we're going to talk about here today. Hedge your stocks against global events with puts. And is there anything going on with the world these days lately? Yeah, of course there has been, right? So what a great time to have this presentation. I will be your host, filling in for Dan Passarelli today. My name is Mr. John Kamisek. I work with him. I do basically most of the one-on-one coaching here. All right, before we get into that, let me point out the obvious, but sometimes not so obvious, that trading and options involve risk and are not suitable for all traders, investors, or human beings, as I like to say. So prior to buying or selling an option, a person must receive a copy of Characteristics and Risks of Standardized Options. Copies are available from your beloved broker, like Firstrade, right? Or by emailing investor services at theocc.com. I did email them a couple times and they never got back to me. So I'm not sure how good the options clearing card. I've been there a few times, but I'm not sure how good they are following up and getting me that copy of that book, the risk book. So, all right. So, not going to spend a lot of time here. This is really pretty much a short presentation here, but like I said, it's just a good reminder, a good kick in the butt, so to speak. Again, my name is John Kamisek. This was a shot from at Beijing. Went to China Futures Association several times to talk about trading with them. I just love that little shot here. So I am first and foremost a trader, and then I've become a passionate educator for the last 20 plus years, knowing how difficult it is as a retail trader to make it as an option trader. So I'm currently the senior option coach at Market Taker Mention. Like I said, I was last in the corporate world, working for Goldman Sachs, and before that, First Options of Chicago. But they did little to prepare me for the retail auditorium that we're all in together here, right? So that I kind of learned from the School of Hard Knocks here. On a side note, I'm a California wine guy and I love food. And even though I'm from Chicago, I just a long time ago I started liking the Broncos, and I've been a Broncos fan ever since. So, all right, protected puts and married puts, essentially buying insurance, right? So we've all bought insurance for sure, right, in the past. And pretty much protected puts and married puts are really the same thing. We'll talk about tactically what is the difference between them, but really they're the same thing. So the outline we're going to cover today is a very, very quick put review, right? Obviously, so we're talking about puts, makes sense to cover that real quickly here. Um, Using puts as an insurance policy, so to speak, not a bad way to go. Again, often so many people, traders, investors neglect this part. We'll talk about the married put. Obviously, we'll talk about the protective put, essentially the same thing as I mentioned, and a general summary. And we'll look at the market. So we'll take a quick look at the market at like a made up example here, just to give you an idea of what it looks like there. All right. So, and again, any questions you have, I don't care if you're a complete beginner, just always ask me, right? So that's what we're here for. So if you ever need me outside of this little session here, john@markettaker.com. Pretty simple email here. So, all right, the put option contract. Right? I always, when I first start working with one-on-one students, whether you're experienced or on the newer side, I always ask them, and there's several different answers that you can give me, and they're all correct. But I always ask them, what's a call option? What's a put option? And it's so funny. You get so many different answers. They start talking about the Greeks and so on and so forth. I'm like, no, I'm not talking about the Greeks there. Just give me the simplistic form of what in this case, a put option is. So put option is a contract that gives the buyer the right to sell shares at a certain price, right? The right to sell an underlying security at the strike price, right? It's just that simple. And I always say, why is buying a put considered bearish trade? Because that right becomes more valuable if the underlying moves lower in price. It's just that simple, right? So of course, like any contract, and a put option is a contract, right? Is contract terms. So maybe it's not as official as your insurance policy or your death certificate policy and so on and so forth here, but it's pretty simple. So the made up example here, we're buying XYZ, which before XYZ wasn't a stock, but now it's a stock. But so let's just go with the buy one XYZ August 70 put at $2, right? So we are buying the right to sell shares at $70 up to August expiration. And we're paying for that right $2 times 100 shares, which in real terms would be $200. So we're paying $200 to have the right to sell shares at $70 by August expiration, right? So when students look at an option chain at first, it's always like, oh man, there are a lot of things going on. There's a lot of strike prices. There's a lot of different prices. The Greeks are all different. It can be overwhelming. I always say there's a lot to take in as an option trader. Lots of moving parts. When you're an investor, two things you can do: buy and sell. But if you're an investor using options or just using options, right? There's a lot of moving parts there. So all right, so let's break it down here. The components of this: intrinsic value and time value here, right? So let's, in our made up example, XYZ stock trading at about $38, and we buy the XYZ July 40 put at $320. So we have the right to sell shares at $40 up until July expiration, when the stock is currently trading at $38. And for that right, we're paying $3.20, or again, $320 in real terms here. So intrinsic value, time value. Yeah, intrinsic value for a put option is the strike price minus the cost of the stock, right? The current cost of the stock. So in this case, 40 minus 38 gives us $2 intrinsic value. Because why? Well, we have the right to sell shares at 40. And how do we make money when we sell shares, even though it's a crazy concept? How am I selling shares I don't own, right? When you sell something, you want to buy it back for less. Obviously, the flip side of that is the easy part. When we buy something, we know we make money if we could sell it for more money, right? Same thing with long options, a long call or long put. So in this case, we have the right to sell shares at $40, and if the stock's at 38, we can immediately buy back for $38, make $2 a share. That's where your intrinsic value comes from. Now, as you notice, the cost of the put option is not $2, it's $320. You're paying for time value because we have, not sure in our made up example here what the date is right now, but we have till July expiration to do so. So we're going to pay to have that time value on there, which is $1.20, which of course is the cost of the put option in this case minus the intrinsic value is the time value, right? So we're paying $1.20 above the intrinsic value for that. So it seems complicated, but it's fairly simple, right? Stock price minus the strike price is intrinsic value, and option premium minus the intrinsic value is the time value. Just that simple. So, all right. So far, so good. All right. So, as I always like to say, too, options for your options here. So exercising, invoke your right to sell the underlying, right? You bought, you're long a put option, right? You have the right to sell shares, right, at that underlying. Now, what most people do, and I referred to it earlier, when you buy a call, or in this case, buy a put, is close that position prior to expiration. Now, I think that's the part where a lot of investors actually think that, well, I own the put, I have the right to sell those shares. Well, no one says you have to sell the shares, right? You could simply sell your put option if it has any value left to it, right? Instead of selling the shares. But I think that's the part that a lot of people forget about, right? Oh, yeah, I don't have to have my shares taken away, right? If I'm long shares of stock and I exercise my right on my long put, well, those shares are going to be taken away. Yeah, but no one says you have to sell your shares, right? You could just sell your put option instead. So selling it, closing it prior to expiration, or expiring, holding the contract to expiration, and of course, at expiration, there is no rights left, right? So now, generally, you do that if your long option, in this case, a long put, is worthless, right? Has zero intrinsic value, and of course, at expiration, has no time value as well. So, all right, now what does all this mean? Insurance, right? You have an insurance policy. But like any insurance policy, right? I was just looking at, which reminds me, I got to call State Farm today, ask them about something about my car insurance here. But with any insurance policy, it costs money, right? And just like my car insurance actually went down since I'm getting older here, well, option premiums go up and down too as well, right? Depending on the volatility of the market environment here as well. So, all right. So let's look pretty similar. You know, the similarities between trading and gambling. Well, I look at it as pretty similar to insurance and options as well. So for insurance, you have an asset value. In this case, would be my car, right? So the options is your stock price, right? So deductible for insurance, right? What I'm paying for my auto insurance, right? Well, that's the strike price for options, right? So if I have a $500 deductible, well, my strike price is my deductible for options, right? Time period, well, time to expiration, right? Obviously, generally, I'm doing my car insurance every 6 months. Here, we could pick different expirations as well, right, with options. So, interest rates, right, for insurance are going to fluctuate. Obviously, the cost of the insurance, so on and so forth. And same thing with options, right? Interest rates are changing at all times. And there's also dividends attached to stock as well, then, too, that certainly can affect the price of the options. And of course, they have to calculate the risk, right? A 16-year-old driver just getting underway versus a 6-year-old driver that maybe has never had an accident, right? The risk is going to be different here, right? Now, as I mentioned a couple of minutes ago, volatility in the market. Generally, when implied volatility rises, right? Fear rises in the market. Guess what happens to option prices? When the market is hanging out, not doing much, or moving higher, option prices, fear is less, and option price and volatility tend to come down. But all that and the insurance part makes up your premium. All that on your option part makes up your option price, right? So now, do you have to know every moving part with your insurance or your option price? Well, you can't. I mean, some people enjoy that. I personally don't, but to each his own, right? So to me, it's a lot of it just taking it on face value, knowing what's going on with the market in general here. So, all right. So protecting a stock, right? Too many times, too many investors that I've run into, hearing stories, tons and tons of stories over the years that, man, I wish I would have did this. I wish I would have done that. Well, like I said, to me, this is a presentation about remembering that, yeah, you do have that, no pun intended, that option, right? So again, the put gives the owner the right to sell shares or the underlying at a set price, right? Which is a stock price. So here we can create kind of a pseudo spread, right? We're long shares and we add a long put to that position. Now, certainly what's the most important position here is our long shares. We hope over time that the stock rises in price, and at some point we'll be able to sell those shares for a lot more than we bought them for, right? But as a protective measure, we're going to buy a long put that has an expiration. And of course, we're going to pay a premium for that. If it has intrinsic value, it might not have intrinsic value, right? You just want it for protection, but it's definitely going to have time value, right? When you buy a put option. So the right to sell stock already owned at the strike price, right? Already owned at the stock price. Now, talked about married put, protective put. Well, generally, it's the exact same thing, but by definition, a married put is buying a put and simultaneously buying the stock at the same time on a share-to-share basis. So if you bought 200 shares, you're buying 2 puts. But here's the key: married put versus protective put. By definition, a married put is putting on that long put at the same time as buying your shares of stock or shares of whatever you're trading, silver or whatever, so on and so forth. So we're buying a put and buying 100 shares of stock at the same time. So yeah, it seems crazy. I didn't know that, right? Married put, and I didn't for a long time. Like, I've always heard the sayings. I'm like, what is the definition between a married put and protective put? Oh, basically the same thing. Just when you buy your put option, right? When you buy your put option. So it's nothing crazy here, right? So again, buying one put, buying 100 shares stock at the same price. So in our made up example, XYZ is changing prices all the time on us here, right? XYZ at $50, right? Bullish, but maybe we're in a kind of a volatile market environment. Maybe the market or even the stock is extended to the upside, right? And you're like, all right, well, it's due for a pullback, man. Look at the run this thing has been on. Just look at the market, right? Since the beginning of the year, right? What a run this guy has been on, right? And you're like, man, this is definitely due, for a little bit of pullback here, right? So you're a little bit worried about it. So again, what if the stock continues to go higher? So you don't want to miss out on the opportunity. So you buy the shares, but being on the protective front, we're going to buy at the money, right? With the stock at 50, we're buying the May 50 puts and we're paying $1.50. So really no intrinsic value. So we're buying a strike price that equates with the current stock price, but that $1.50 is time value. So we're paying $150 for an insurance policy, so to speak, right? So again, we own the right to sell 100 shares at $50. Now, can we technically lose money on this trade on the shares? No, we bought them at 50. Even if the stock drops down to $25, right? We have the right to sell shares at $50, but technically we paid $1.50 or $150 in real terms. So technically the most we could lose on this trade would be $150. So it's interesting when you kind of frame it that way. Like, yeah, why? As an investor, and you haven't done many of these, like, yeah, why haven't I done? Now, obviously, this is made an example, and depending on how volatile the underlying is, sometimes the cost will be a little more expensive than that, right? So again, with different stock prices and XYZ, right? The premium's not changing. We paid $1.50 for it as a moment in time, right? But the put value can change, right? Would we prefer the stock to continue to move higher? Absolutely, right? So if we lose money on our long protective put here, right? Our married put, are we going to be sad if the stock moves $5, $6, $7, $10, $20 higher? Absolutely not, right? That protection was in place. But if the stock keeps dropping, right, that put value increases in value, right? Increases in value. And we can either sell the put and retain the shares or exercise our right to sell the shares, right? It's just that simple. So again, let's say the stock dropped down to $47, right? We paid $1.50 for this. Put is going to be worth at least $3, right? So we could simply just sell that. Right? So we're down, what, $3 a share on the stock, but we paid $1.50 and now we have a put value of $3. So we can make $1.50 per share. So really we're down what? $1.50, the original put premium, right? And the P&L is what? Up $1.50 on the put option itself, right? Overall, the shares are going to be down, right? $3 a share, so on and so forth. But again, we could just simply sell the put. What if you're taking the notion, and we don't want to be too much of a over, positive about this, that the stock's always going to come back. But what if it is trading in a range and it drops down to like $47? That's kind of a support level where you expect it to move higher again. Well, this is where you might not want to sell the shares if you expect them to rise, reverse off that support level. But what a good time to sell your long put and take some of the value from that and expect the shares to rise again, right? You can always put on another long protective put as well then too, which is pretty cool. So, all right. So in this particular case, right, we're on limited max profit on this trade, right? Shares can go up forever. XYZ cures cancer. Stock goes up forever and ever and ever. The most we're ever going to be out on this trade is $1.50. Now, here's the plus side, right? The most technically we could ever lose on these shares are $1.50, what we pay for that put. Again, we bought the put at the same strike price at where we bought the stock currently, right? If there was a difference, you'd have to take the difference. Like if the shares were trading at 52, right? When we bought them, we bought the 50 put, then we still have $2 there to lose as well then, right? Possibly. So, but in this case, right, whether we sell the put option or exercise our right to sell the shares, we're out $1.50 a share, or $150 in real terms, right? So again, sometimes, like I said, it just takes some time. And our break even, naturally, since we have to cover the cost of that long put of $1.50, our break even at the put expiration, right? Because stock doesn't have any expiration, would be 51.50, right? So, which is pretty cool. So, all right, to protective put, it's going to be the same thing. So we'll quickly go through this, right? The only difference is you've owned shares and now you're buying a put. So again, really it's the same thing. Forecast should be about the same. If we're holding on to long shares, we haven't sold them for a profit already, right? We think it's going to go higher, right? But again, there might be some volatility. It might just be some geopolitical stuff going on. So the married put, we put it on at the same time. Protective put is we're putting on after we've owned the shares already. So same principle applies here, right? We're already long the shares of XYZ, which are currently trading at $50, right? Hopefully we bought them for a lot less earlier, right? Months and months ago, but we're going to buy the May 50 put again at 150. So at this point, the most we could lose at this point is again $150. Same thing as the married put, right? So again, we own the right to sell shares, 100 shares at $50 up until May expiration. So guess what? Is this going to look exactly the same? Indeed it is, right? No changes here, right? Clearly, we want the stock to continue to outperform, move higher and higher and higher, and waste that $150 we bought for that put option, but our stock is up another $10 a share, right? So basically, this is exactly the same as the married put, and it should be because they're basically exactly the same. It's just the timing you put it on. XYZ drops down to $47. We paid $1.50 for our long protected put. In this particular case, the put's going to have $3 intrinsic value, and the P&L for the put itself will be up $150, right? Or we could just sell the shares at $50 and we'd be out what we paid for that long protected put, right? So guess what? Shockingly, the P&L diagram is going to look exactly the same, right? We need to cover that $1.50, whether we put it on at the time we bought the shares or we put it on later after we've owned the shares previously. The break-even point at the put expiration is going to be 51.50. So, all right. Now, intrinsic value, time value, obviously, we're talking about at expiration, but before expiration, you're going to have some time value attached to it as well. So it's not just the intrinsic value, like the stock going back here, stock drops down to $47, and let's say there's 2 weeks left until expiration. Is that put option going to be worth $3? No, it's going to be worth a bit more. The intrinsic value is going to be $3, but there'll also be some time value attached to it as well. So that's what you have to think about. But of course, at expiration, options have intrinsic value or no intrinsic value and absolutely no time value, right? And that's how they expire worthless. When your option has no intrinsic value, because it has no time value either, it would expire worthless. So, all right. And what does that cause from? Time decay, time passing, right? Theta. For every 1 day that passes, theta is going to decrease the premium by that amount. Clearly at expiration, there is no time left. So even if there is intrinsic value, there's no time value left at all. So, all right. Again, exercise your right to sell the underlying. Right? That's if you take the notion that I believe the underlying is going to drop further in price, or if I'm not sure, you could always get back in, right? Always get back in. Look for a buying opportunity, a buy setup, so to speak, on the chart, right? Sell, close the put option prior to expiration and expire, right? Hold the contract expiration Yeah, maybe your stock has gone from 50, XYZ has gone from 50 up to $60. Well, guess what? Your protected put or your married put is going to expire worth this, and you're fine with that because you made $10 a share, even though it costs you $1.50 a share, right? The right sees at that point. So, but generally, a lot of people will sell that option closer to expiration. But again, as a reminder, if you believe the underlying's going to continue to drop, don't be hard-headed, right? We have to, as a trader, you have to admit you're wrong. And that is so difficult to do at times, isn't it? Admit you're wrong. Because as human beings, we're certainly not ingrained to be wrong about things, right? And that was my biggest thing overcoming it when I jumped to the retail front is you're going to be wrong, right? You're going to be wrong lots of times. And again, it's not ingrained to be wrong about things. So you can't let your ego get in the way, even though it wants to, right? As human beings, we want to be right. And being wrong with trading and investing is going to happen quite often, but it's how you handle that is the key ingredient there, right? So, all right. Tactical considerations. We talked about this a little bit earlier here, right? How much is the premium, right? Option prices fluctuate. Right now, option price implied volatility level is a little bit on the higher side with everything going on with the market. Obviously, doing a lot of yanking around here, a lot of slop and chop and yuck and muck, as I like to call it, going on here, right? But $1.50, right, of that $50 per share stock, it represents 3% of that, right? So you don't want to always slap it on. Now, we're not Nostradamus. We're not here to predict the future. Otherwise, we'd all be billionaires as traders, right? We know exactly what's going to happen. So it's easier said than done. You don't want to use this selective use at certain times, but yeah. Do we know when the market's going to drop? No, but times like this where there is a lot of volatility, where the market went from trading neutral to going into a downtrend, sending lower pivot lows and lower pivot highs, right? Didn't mean it was going to continue to drop like it has the last couple of weeks, but that's where there are obvious times where it does make sense to consider a married or protected put for your shares of stock, right? I always, almost every class, as a reminder, I say, protect yourself as an investor, right? Don't just hope and pray. Hope and pray. There's nothing wrong with hoping and praying, but you want to have a plan underneath that, right? So I hope and pray my positive delta positions go higher and negative delta positions go lower, but I have a plan in place. I'm not just aimlessly hoping this stuff happens here, right? So, all right. Quick summary here, right? Married put, protected put are always ways to protect the value of underlying security. I know we didn't talk about collars here today, where you're selling generally a call option higher than where your underlying is trading to help pay for that. But that's certainly, a feasible way to approach it as well then too. So a married put is buying the stock, again, in one transaction, and a protected put is buying the put on a stock that's already owned. So, all right, now let's take a quick look here. Pull the chart. Let's say, of course, we own shares of Apple, right? And of course, if you bought Apple, I don't know, let's say sometime at the beginning of the year, I'm a fresh start here. I want to buy some Apple shares, but it's going to go higher. Now, of course, it hasn't got killed, but you're down about $20 a share if you bought them in the 270 range. And certainly a protective put, married put at the time you did it would have worked out pretty well. Not always, right? We had a big drop at the beginning of the year, kind of rallied back, so on and so forth. But let's say you're looking at Apple right now, like, all right, well, you kind of see, draw a little potential kind of support level in this level. Let's call it about 245, right? Now, of course, with the stock trading at 250 and change, we'd have zero intrinsic value, right? Because we're buying a lower strike put, right? A higher strike put's going to have intrinsic value. So here, this is all going to made up time value. But if we buy a 245 put, we have a right to sell shares at 245. So with the stock trading about 250, we can lose an additional $5 a share plus the cost of our long put, which we'll take a look at in a second. But bottom line is, again, no one says we have to sell our shares, particularly if you believe Apple is going to rally off that level again. Maybe we'll just sell the put and, make a little profit on the trade. Hopefully, if there's time left on it, there's some time value punched in, right? Because there's not going to be really intrinsic value if it's trading above 245. But maybe some time value will be involved. Like, let's say Apple moves $3 lower tomorrow and you put it on today. well, that put option is going to be worth more than what you paid for it if you bought it today when the stock's up, $3.50 currently. But either way, let's say Apple put this on and just something dramatic happens in the world, right? And then over the next couple of weeks, Apple is down to $215, right? Again, you could sell your long put. That's going to have plenty of intrinsic value at that point, right? Or if we bought the 245 put, we could sell the shares at 245 and be done with that trade, right? So if we look here, right, let's pull up Apple. Let's go to April monthly expiration, which is April 17th. Right? So if we buy the 245s, it's going to cost us $395. Oops, sorry, my mouse was stuck here. It's going to cost us $395, right? So $395 in real terms, basically $400. So just rounding it up to $4, right? What's our break even at expiration? Well, I'm doing the 245, right? Stock's trading at 250. Right? Well, think of it that way, right? How much higher does the stock have to go? Well, pretty simple in this case, right? We bought this guy for $4. Right? Stock needs to go $4 higher, at least to break even, right? Based on our protection. But I always say it's more than just break even, this and that. You're paying for it. You're sleeping. I like to say sleeping better at night, knowing that no matter what happens with Apple, which you prefer not to happen, right? And I do this sometimes over earnings announcements too. Are you cheering for your protective put to make money over an earnings announcement? No, you'd rather have the stock gap higher, a lot higher, because your shares are going to have a delta of 1, right? For every penny, they go higher or lower, you're going to lose a penny, right? So you're never cheering for the stock to go lower in this particular case either. But this is just protection. As I say, sleep better at night, knowing no matter what happens, you're protected to the downside to some degree, right? We can still lose $5 a share, right? And of course, we paid $4. So really, again, you take that into place, but still, we have some protection in place. And to me, that's worth more sleeping better at night, right? What do they say? When you're worried about your trading overnight or while you're laying in bed, well, guess what? Yeah, you're either trading too much, too big contract size, or you're just not effectively managing the position as well. So just be a little bit careful with that. So, all right. So in this case, right, if we own the shares already, right, it'd be a protective put. If we're buying the shares right now in Apple and buying that put, it'd be considered a married put. So, all right. But any questions? Like I said, it's fairly straightforward here. But like I said, it's just a good reminder as an investor in this market conditions, right? You're like, oh, the market's dropped already so much. Is there anyone thinking that it might not drop anymore? I'm not saying it will by any means, but the fear is always there. Again, you don't want to trade in fear. You don't want to always buy puts for protection, but there are times where it's better than other times. So all right. Any questions at all? Like I said, it's pretty straightforward. I appreciate your time as always. But like I said, hopefully if it makes you think about, I really haven't done that in a while. I've just been writing out my shares and so on and so forth. But hopefully it gives you that kind of a thought process that is, no pun intended, an option to do. So, all right. Again, I appreciate your time this afternoon. I will be with you again one more time next week as well. I think Dan will be back after that. So thank you so much. Have a good rest of your day. Talk to you guys later. Bye-bye.